Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 6th of July. European futures look cautious this morning after having advanced to a fresh all-time high level last Friday. Lower oil prices continue to support the inflation outlook, hence give some relief to the investors and keep these prices rising. Yet beneath the calm surface are some uncomfortable questions regarding the technology valuations, the Federal Reserve and other central banks' next policy moves, the memory chip prices that squeeze profits, and SpaceX inclusion to Nasdaq 100 this week. So we will talk about how investors feel and what will shape the new week. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So last week ended on a positive note for European equities as US markets were closed due to July 4th holiday. The Stoxx 600 index advanced to a fresh record high on Friday despite a slight rebound in bond yields after Friday's PMI data printed better than expected activity levels in June in the euro area. Services especially printed a stronger than expected figure, perhaps due to the sunny weather coupled with the World Cup. The FTSE 100, on the other hand, is also approaching its own all-time high levels reached back in February this year, and that despite falling oil prices and the downside pressure on mining stocks. And speaking of oil, Friday's data show that many OPEC countries increased their production levels, and they also announced to raise their output by 188,000 barrels per day, further unwinding the restriction strategy put in place back in 2023. That announcement came on Sunday. The increase won't change global supply materially, but comes at a time when supply glut talks resurface, pulling oil prices lower along with the de-escalation of the Middle East tensions, and after the UAE quits OPEC, hinting that an upcoming battle for market share in the oil market rather than cartel-boosted profits. So, U.S. crude consolidates near the $68.5 per barrel level this morning, with downside pressures still prevailing, and that despite some jittery news in the Strait of Hormuz suggesting that some tankers made U-turns but eventually crossed the Strait of Hormuz. So the new week starts on a mixed note. Really, European futures are pointing at a cautious start at the time I'm talking here this morning, while the technology-heavy U.S. futures are leading gains this morning before the European Open, and that despite mixed sentiment for technology in Asia. Because the Korean Kospi Index, for example, which is one of the most heated indices of late, is slightly sold this morning, though recovering losses at the time of talking after news that Samsung there would increase the price of its memory chips by another 20%. Remember, up to high triple-digit percentage rise in memory chip prices over the past year have started to squeeze the profits at hardware makers, including names like Apple, making the demand outlook cloudier for the memory chip makers at these prices, and hence making investors quite anxious and undecided about whether the news was good for Samsung or they were bad. Samsung initially jumped but has given back gains since then and is up by around 0.80% only at the time I'm talking here this morning, while SK Hynix, which prepares to be listed in the US this week to tap into a deeper US financing, starts the week with a more than 3% loss. Now note that the company's PE ratio is around 21.5 versus 21.90 for Micron. So to me, and after a more than 1,700% rise in a bit more than a year, I'm curious to see how much juice the company could squeeze out of the US markets at a time the bubble worries across technology stocks, and especially the memory chip makers, are getting louder and taming appetite. Because another piece of good news came from Hon Hai Precision this morning, which is also known as Foxconn, which is Apple's main iPhone assembler and a key manufacturing partner for NVIDIA's AI infrastructure. So the company reported a 40% jump in its quarterly sales this morning, beating estimates, but alas, its share price barely reacted to the good news, showing how investors are not feeling necessarily enthusiastic about the good news as they have already been priced in broadly, and now the bubble talks are taking some lead. So this week, investors will continue to question the technology valuations, whether they have gone just too far, whether these valuations make sense, or it is just another great bubble like the ones that we saw in the past, like the railways or dot-com bubble, that is waiting to be but while watching SpaceX enter the Nasdaq 100 index this week. Remember, Nasdaq changed the rules, the inclusion rules, to include SpaceX that would normally not make its way to such a broadly watched and traded index globally, including the free float rate, for example, that remains very, very extremely low for SpaceX, the governance, with Elon Musk having more than 80% of voting rights himself, and the company's fundamentals. And here I'm talking about the fact that the company went public at a valuation of 100 times its last year's sales. Not earnings, guys, sales. So it's needless to say that SpaceX inclusion in NASDAQ 100 will increase the NASDAQ 100's volatility, but also its capacity to represent the underlying economic and financial fundamentals, and potentially its credibility as well. And note that this week is also the end of the quiet period for SpaceX, meaning that Wall Street firms and analysts will start publishing their first research reports and their predictions as per the stock price perspective. Note that the early day enthusiasm in SpaceX faded fast after the IPO, with the price now coming close to the IPO levels after a more than 50% surge in the very early days of this company trading publicly. Elsewhere, some consumer-facing companies, including PepsiCo and Levi's, will be reporting their earnings in the US this week, and the FOMC will be releasing the minutes of its latest monetary policy meeting, where the new Fed chair, Mr. Kevin Warsh, put his emphasis on price stability, remember, and refused to include his own projections on the dot plot, arguing that forward guidance and Fed members' frequent comments have maybe gone ahead of themselves, suggesting that there could be a change in the Fed's communication strategy and the way it communicates with the markets, and its very maybe too close relationship with investors in the coming months and quarters. Now, even though the falling oil prices have tamed inflation expectations in the US and elsewhere so far, the market still priced in one interest rate hike from the Federal Reserve this year in the second half of the year, and the latter hawkish shift in Fed expectations continues to provide support to the US dollar globally. The US dollar index is well bid this morning against most majors, with the euro dollar consolidating its recent losses below the 115 psychological mark, and the dollar yen actually starting the week with yet another leg up after Goldman Sachs analysts revised their prediction from 155 to 165 for the dollar yen within the next 12 months. Now, not that we are at levels in terms of dollar yen that would have normally triggered a direct FX intervention from the Japanese authorities. We are at levels that may still trigger an intervention at any moment. But we also know that the FX interventions prove to be short-lived and will not reverse the yen's depreciation when the underlying fundamentals, which means the rate differential between BOJ and the rest of the developed world, remains so supportive of further weakness. FX interventions are actually like giving paracetamol to treat the symptoms of a disease without necessarily healing the wound. And what's notable here is that the yen's weakness is due to, as I said, an abnormally low BOJ rate and a very, very large yield gap with other DM peers as a result of it. But the low interest rates in Japan do no longer necessarily help the Japanese companies perform well or feel well. In fact, the Japanese bankruptcies are very high today due to the undesirable side effect of the weak and the weakening yen. In this context, the BOJ better raise interest rates, normalize its monetary policy to give relief to the Japanese economy, which can't really enjoy this low interest rates anyway. So if that happens, if the BOJ further normalizes, which is the base case scenario, then the Japanese investors could repatriate their funds back to Japan and hence pull the rug from under the feet of the global risk markets, which has been benefiting from this ample Japanese funds since decades now. Plus, abundant liquidity has been enough so far to tame reverse carry trade worries since Japan's 10-year government bond yield broke above that critical 1.70 to 1.75% range, remember? That was once feared as a trigger of a reverse carry trade, and today, Japan's 10-year yield stands near the 2.80% level, pushing higher. This is the highest levels in the case. It's still rising, yet no one seems to care. As generally, when you expect the least, that markets deliver their nasty surprises. So on that note, this is all for this Monday. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.